Well, here we are in 2023, and wow, what a difference a year makes. A lot of things have changed, especially in the real estate market, but there's still some tried and true ways of purchasing a home with very little money down. So in this video, we're going to cover if you're a first-time home buyer or if you're somebody who owned a home before, but have been renting for the last 1 or 2 or 3 years and want to get back into home purchasing, but have very little means of doing that. This video is for you. So let's kick it off right now. I'm Kevin Fagan. I am the Mortgage Patriot on your side here in the great state of Texas and serving Texans as well as individuals all over this country. Please like and subscribe to this channel. It allows me to put in front of you some great content that's going to be valuable to you on your home purchasing or home refinancing or investing journey in real estate. I would love to be able to help you out. So again, like and subscribe below, and I'll provide a number that you can call because I love to hear from people all over and hear what your circumstances are and how we can best provide a solution. Let's get into our exciting subject of how you can buy a home with very little down and enjoy home ownership. There's a few ways we're going to cover them today. One is VA loans, and then we're going to explore USDA loans and FHA loans. So those are your three big categories. And on the conventional side, there is a product or a solution that allows for only a 3% down. So we'll cover all four of those. In particular, we're going to get into closing costs and walk through all that. Just because a lender will say to you, or you see on a billboard, 0 down, that is referring to the down payment. You're still coming out of pocket for quite a bit. So we want to explore all that, break down some misleading areas, and maybe show you how to cover closing costs. And at the end of this video, you're going to be well prepared to not only know what your best option is, but know how much you're probably going to be coming to the table with, because it's going to be some small amount regardless of the strategy that you use. So let's get into that right now. Now, as I walk you through these programs, I want you to visualize three categories, or what I like to refer to as three buckets, because when you buy a home, just because a lender or again, some advertisements from whomever will say, there's 0 down payment, that doesn't mean that you're not paying any closing costs when you actually purchase the home. So the three buckets that you're going to be responsible for in terms of cash to close is bucket number one is your down payment bucket. And that's relatively self-explanatory. If you have a 0 down payment, like a VA or a USDA loan, it's exactly that. You buy a $300,000 house, your loan amount is $300,000. There's no down payment, but you have bucket number two, which is the actual closing costs. Those are the real costs like title work, appraisal, underwriting, processing, recording, and so forth. Those costs add up quickly and they can be fairly substantial. And bucket number three are escrows. You have to build an escrow account. We'll talk about all these as we go along, but again, you have three buckets. And just because you have a 0 down program, they're only referring to bucket number one, the down payment bucket. Your other two buckets, you're going to be responsible for. So that's why it's very misleading, I think, when someone says, well, you can get into a home for 0 down payment. Yes, you can, but you're still responsible for closing costs, the real costs, and your escrows. So let's explore that right now as it relates to each category. So let's cover veteran loans for a little bit here. My stepson, my son, my stepdaughter, I've got a lot of near and dear relatives that have been in the military and are eligible for VA loans. And so I've done quite a bit of VA loans, not just with them, of course, but with other families across the country. And so my heart goes out, obviously, to quite a bit of the military families who give up and sacrifice for this country. So thank y'all very much. What makes the VA loan very special is the 0 down payment element that we spoke of earlier. You want to buy a $300,000 house with a VA loan because you're either a veteran or you're a surviving spouse of a veteran or you're the spouse of a veteran. You have that ability to purchase that $300,000 house with a loan of $300,000. Now, other great things about the VA loan are there is no monthly insurance premium. On an FHA, we'll speak about that a little bit. They assess you a monthly insurance cost along the way. So if you had a $300,000 FHA loan and a $300,000 VA loan, your payment on an FHA loan is going to be much higher because internally on a monthly basis, you charge that monthly insurance premium. That does not apply on a VA loan. So not only is it a zero down payment loan, but there's also zero monthly insurance premium. So that makes a VA loan very attractive relative to the other options. Now, again, you have to be a veteran. So clearly this is not for everyone, but I wanted to cover that up front. And one other good aspect of a VA loan is depending on your circumstances in terms of a disability, a lot of military folks are assigned a disability percentage. If your disability percentage gets up into the 70, 80, 90, 100% disability area, in certain states, you are exempt from property taxes. So here in the state of Texas, if you have I think it's 80, starts at 80 actually, but certainly at 100% disability, you pay no property taxes. So again, let's take that hypothetical $300,000 home. You're able to buy that house for a loan of $300,000. You still have closing costs in the second bucket. You still have escrows that we talked about, but your first bucket, your down payment bucket is zero. So your loan amount is $300,000 and your property taxes, you pay with 100% disability as a VA, zero property taxes for the year. So an enormous amount of savings. So that's why a lot of veterans who have high disability percentages flock to Texas for a number of reasons, but certainly because they are exempt from the property tax. What a wonderful benefit that is. Let's talk about now a second program that you can use potentially to purchase a home with zero down payment. It's called the USDA loan, USDA. And who is eligible for it? It mainly applies to what they call rural properties, but the definition of rural has been expanded over the years. So basically, it's anyone that's not necessarily in a true metropolitan inner city or normal suburb within that metropolitan area. For example, if you live in the extended suburbs of the city, be it San Antonio, Austin, Texas, anywhere across the country, just outside of those city limits, typically is available for a USDA loan. And again, that USDA loan is a zero down loan. So if you're buying, again, let's take that $300,000 hypothetical purchase, the USDA loan would be for $300,000. Now let's break down some of the aspects of the USDA loan, because it would seem like everybody would want to use it, and they would if they knew about it and they were eligible. But as there are with any program, there's criteria that possibly will limit you. What is it with the USDA? Well, it's a more conservative loan, meaning the amount of debt that you have relative to your monthly income is not allowed to be very high. The VA loan, as we described before, allows for the most debt relative to your income. Then just below that is the FHA loan, then conventional, and then USDA is the most restrictive of all those four types of loans. It only allows for up to about a 41% debt to your income. So if you buy a home, and let's say it's $300,000, your principal, interest, taxes, and insurance, plus whatever other monthly expenses you have, like car payments or student loan payments or installment loans or credit cards, all the debt, your housing expenses and your other debt cannot exceed 41% of whatever your total monthly income is. That's pretty tough on some people. But for the people, obviously, that can fit into that little box, USDA is a great alternative. Zero money down. And unlike the FHA loan that assesses you a fairly large monthly insurance premium, the USDA loan does also assess a monthly insurance premium, but it's not even half of what the FHA loan is. So there is an ongoing monthly insurance premium, but it's just relatively small on the USDA program. And lastly, USDA loan does assess a 1% fee up front to pay for their insurance coverage in case you were to default, but that can get rolled into the note. So great alternative for people that are living just on the extended circumstances around a city or their outer suburbs. Like I say, I can show you if you're eligible. If you give me a call or send me a text or write inside the comments here in this video what your zip code is, I'll tell you right away whether you're eligible for a USDA loan. So that's always a great alternative. So now let's get into that last category, and it's FHA. FHA is not a zero down program. it is a 3.5% down program. So you have to come out of pocket for 3.5% of the purchase price. When we talked about that $300,000 property that you're trying to buy, we're just going to stick with that same example. You're having to come out of pocket for 3.5% of $300,000. That's about $10,500. And you're still responsible for closing costs and escrows. Remember those three buckets: down payment, closing costs, and escrows. So FHA actually can add up pretty high. Let me talk a little bit about FHA requirements, and then we're going to break down the professional tips of substantially lowering all those three buckets so that you come out of pocket very little on an FHA loan. Let's talk about the great advantages of an FHA loan. There's mainly two. And the first one is debt to income ratio. Debt to income ratio is just all your debts, which includes your housing, principal, interest, taxes, and insurance. That's your housing expenses, and your other remaining debts, your revolving cards, your installment loans, be they student loans or car notes, for example. All those debts as a percentage of your income. That's your DTI. That's your debt to income. That ratio is allowed to be higher. You're allowed to have more debt with an FHA loan than any other loan program. So with USDA, like we said, that percentage is only 41%. It's quite low. With conventional loans, it's around 45 to just below 50%, depending on other factors. With a VA loan, that debt to income can be actually quite high, but they use a completely different formula. So the FHA allows you to go up to about 55, 56, 50, even 57% of all your debt, your housing expenses and your other debt can be 56 to 57% of your total income. So now you have the ability to own a home if you've got a fair amount of car payments, installment loans that you currently have. The FHA loan is the avenue of choice in that scenario. So that's benefit number one. Benefit number two is lower credit scores are allowed. So let's compare that to the USDA program. A 640 or better can usually get you eligible for a USDA loan, assuming other factors apply. With a VA loan, they like to be around 600 to 620 at a minimum, but I've seen deals where you can get VAs at a lower score, certainly, but those are special circumstances, and sometimes you have to come out of pocket for a down payment. So a traditional VA loan, 600 to 620 at a minimum. On a conventional loan, roughly the same area. You want to be above 620, certainly for better pricing. You can go as low as 600, even much lower, but your down payment keeps getting increased. The lower your FICO scores on a conventional loan, the more you have to come out of pocket for a down payment. But for an FHA loan, that FICO score can be as low as 580. So 580 score or higher, you can enjoy a 3.5% down FHA loan. So it's a lower point of entry. The FHA loan is the most used loan for a first-time home buyer or for someone that's got circumstances that aren't necessarily as strong as maybe another borrower. FHA loan is probably going to be your best bet. So let's take the last few minutes of this video to do the most important part, and that is to show you how to minimize all these closing costs. Because remember, the down payment, even if you can avoid that with a VA or USDA loan, is not your only set of costs. So let's do a quick review. We have three buckets of costs. We have the down payment, which could be from 0 to 3.5%, depending on what kind of loan program you have. And then you have the true cost, all these closing costs, which are your appraisal, your underwriting, your inspection, your title fees, your government recording, your processing. Those are the true costs of doing the loan. And lastly, your escrow buildup, your escrow account that needs to be created at the beginning of your loan. So let's go to the $300,000 purchase that we've been talking about all through this video. On a $300,000 purchase, at least in the state of Texas right now, these are just estimates now, so don't hold me to them. It's going to cost you about $5,000. The escrow buffer, the escrow buildup, is going to cost about $3,500. So you have $8,500 roughly of costs that you have to come out of pocket for, even if you get a zero down loan, be it VA or USDA. So again, on a $300,000 purchase, let's take the worst case scenario. An FHA loan, $300,000, 3.5% of that is $10,500. Now you have on top of your $10,500, you have $5,000 for true closing costs, and you have $3,500 for your escrow funding. So you have a total of $19,000. That's a pretty good chunk of change. So the way to reduce all these closing costs and down payment is through a combination of three things. down payment assistance, seller concessions, and if available, lender credits. Down payment assistance, seller concessions, lender credits. So let's examine each one really quickly. So you have on an FHA loan, $19,000 that you're going to have to write a check for at closing. How do we get that down? Down payment assistance number one, that's going to be your biggest opportunity. We could spend a whole video on down payment assistance program, but the bottom line is there's thousands of them literally across the country because some are national programs, some are state programs, some are county programs, some are city programs. Everybody's got their own different types of down payment assistance. Some are not available to you because of restrictions on FICO scores, on geographic areas, on how much money you make, on your actual debt to income ratios. So you don't qualify for most down payment assistance programs, unfortunately. But let's assume that I can find you one. And odds are I can at least find you one that'll cut off half of your down payment. So down payment is 3.5%, $10,500 on an FHA. Half of that would be $5,250. So I can eliminate $5,250 with a down payment assistance program. Now we've knocked down your $19,000 to, what is that, $13,750. We've already covered $5,250 on a down payment assistance program. Now let's see if we can do better than that. With seller concessions, what are seller concessions? Seller concessions are the selling party allowing you at closing to take some of that purchase price and use it to cover your closing costs. For example, again, if you're buying that $300,000 house, the seller's going to say, okay, I'll give you back $8,000 at closing to cover your closing costs. Why would they do that? Well, last year they didn't have to because the market was so hot. Every seller knew that if you couldn't perform, they could sell it to somebody else for every bit what you paid for it and more. But now the market's cooled down. Sellers are ready to negotiate. They're ready to say, for example, yes, I'll let you buy my $300,000 property per your loan agreement and per your notes and per your deeds, but I'm going to give you back $8,000 at closing to cover your costs. So that's seller concessions. Now we were at $13,750. Let's take out another $8,000. Now we're down to $5,750. Now we're getting pretty close to a very, very manageable number. And lastly, that last bit of technique is lender credits if they're available. So I, as a mortgage loan officer, can potentially help cover some of your closing costs. Let's say I give you $1,000 towards your closing costs. So now we've gone from $19,000 to $13,750 to $5,750. Now we're at $4,750. Here we are at that magical number of what I've always thought that you can probably get a home anywhere from $200,000 to $300,000 with as little as $5,000 in your pocket for all the costs, your down payment, your true closing costs, and your building your escrows. And by using all these combinations of what type of loan you're in, be it USDA, VA, FHA, or conventional, and you add to that the elements of down payment assistance, seller concessions, and lender credits. All that combines to getting a very manageable number. I can help you with that. This is where I shine, and this is where my great interest is in helping people out like yourself. So call me, 210-317-6514. Text me, email me at the email that you see below, or put in even in the comments that you're looking for a home, be it in Texas or otherwise. You'd like to know, number one, if you can qualify. Number two, given a certain price level, how much would you probably have to come out of pocket for under normal circumstances or circumstances where we could add these elements that I'm referring to of the seller concessions, down payment, and so forth. I can bet you that in most cases, I can get that number down from anywhere to $5,000 or $7,000 to $7,000 or even less. But I feel more comfortable if you have in your back of your mind that you're going to come to the table with at least $5,000 to $7,000, no matter what the price tag is. So my name is Kevin Fagan. I'm the Mortgage Patriot, here on your side, and make it a great one.